To talk to us more about the recent inflation figure, we have with us on the show Security Bank's Chief Economist, Robert Dan Roces. He is joining us via Zoom. Welcome to the big story, Dan. Dan, is the 7.6% March inflation within your bank's forecast range?
Well, admittedly, it was a surprise. It was a downside surprise for everyone. We were expecting 8%. My range actually was around 7.7 up to 8.2. No? So it was a little bit below the lower range of our forecast.
All right, Dan, one notable thing about the report of the PSA today, core inflation actually went up by 0.2% to 8% in March from 7.8% in February. What does this tell you?
Well, core inflation is often considered a more stable measure of inflation because it excludes the volatile components that can fluctuate significantly in the short term. It's always sticky going down. It always lags the headlines deceleration. Current estimates show around 2 to 3 months. So, like what we saw today, or rather, the data from March, when core inflation surpasses headline inflation, that usually suggests that inflationary pressures remain broad-based and sticky. So that indicates an elevated near-term inflationary trend in the economy.
Yeah, but having said that, do you see inflation dropping to government's target this year, or can you also say that that inflation has already peaked?
Well, yeah, it's the base effect already kicking in. We saw inflation in 2022 begin to go up beginning March. So, year on year, that should actually pull down the headline. But you have the base effects now, which could be a bit misleading. So it's also important to look at the month on month. And the month on month actually shows some deceleration. So it's a negative growth month on month. So that's actually a positive development.
Right, and of course,
it's driven by
right. Go ahead, Dan. Go ahead.
Sorry. Yeah. So it's driven by falling prices, notably in food, but also in transport. But as you said earlier, core remains high and continues to rise, suggesting that underlying inflationary pressures may be persisting in the very near term.
All right, and as it is, because of inflation rising all of last year, the BSP has raised interest rates to the current 6.25%. Now, that is the main arsenal of the BSP when it comes to controlling inflation. Do you think that this current print for March will prompt the regulators to ease up on this aggressive tightening, or could we still see rates shooting up going forward?
Well, the monetary authorities will be looking for prices to fall outright, not just a deceleration in the year-on-year inflation. So with the core inflation side remaining sticky, there's an upside risk for the BSP to continue tightening, should the data support it. So the inflation dynamics actually warrant close monitoring, particularly oil price impact following the OPEC decision to cut supply, which actually drove crude prices up last Monday. So that and the core inflation trends and the potential impact will also be considered. So we think, unless there is a retreat in core prices overall in April, or a very weak first quarter GDP report, which will be out on May 11, there's that risk that the BSP will continue its tightening cycle. They could probably increase by another 25 basis points to bring the policy rate to 6.5% when they meet in May 18th. However, we do think that the monetary authorities have really done enough. They've been doing the heavy lifting. It needs that national government complement. And so with the peso, relatively behaved compared with last year, loan growth actually beginning to weaken because of the rate hikes that the BSP did last year, and then an inflation trajectory that points to deceleration for most of the year. The BSP also can pause at the current 6.25% policy rate. Rate cuts could only take place probably 2024, no? Probably second quarter, after we see the full 2023 GDP growth numbers. No?
All right, so still 1 year to go before possible lowering of rates. Now, we've spoken about monetary policy as the main tool for controlling inflation, Dan, but what about from the fiscal side or a non-monetary measure? What else can the government do to support the macroeconomy in general?
Well, it's all about, at this point, it's supply. No? Compared with what the U.S. Has been experiencing relative to their inflation, there it's mostly wage-driven. Ours is not necessarily wage-driven. No? Well, I mean, we're seeing some very good demand from consumers. No? So that's also driving the core inflation side. But all in all, it has something to do with supply. So food has been the main driver. Fortunately, it has been going down month on month, no? But it's still the prime driver still. No? So I guess the national government has to really anticipate where it's going to hit the most. No? So right now it's still food. So, we have to be importing more of items that will prove inflationary somewhere down the road. No? Also, we have to be cognizant of the fact that there's this risk that oil prices could probably shoot up because of recent geopolitical developments. So with that, I think it will be prudent for the national government to probably consider stockpiling. Like I said, it's still supply driven. So control the supply, make sure that there is enough supply. Then you can be sure that inflation will be going down.
All right, thank you as usual for your insights, Dan. Dan Roces, Chief Economist over at Security Bank. Thank you for your time.